Stablecoins, are they a true financial innovative tool to help protect the wealth and hard-earned money of retail investors like you and I? Or are they more pernicious and actually a financial booby trap that has been created to secretly and actively siphon wealth and extract purchasing power from everyday wage earners, savers, and bondholders? Now, if you own any of these assets that I just described, and you're of the belief that they are maintaining their purchasing power in this current financial environment, then by the end of this video, I'm going to completely dispel that belief. And I'm actually going to show you at the end what I'm currently doing with my portfolio to actively hedge against this insidious process and what you can do today to protect your purchasing power. And on this episode of Medicine to Macro, we are going to dissect the Genius Act that was passed last year in July and talk about the future of digital fiat, because this is where the future of money is going. So the Genius Act, like I said, it was passed in July last year. It really didn't get too much coverage, too much fanfare, but breaking it down for you, what it does is it means that the stable coin, a digital token, is worth $1, okay? And it has to be backed by treasury bills, 93 days or less, okay? So short-term treasury bills, this is the collateral that the financial system is built on. The financial system is built on debt. If you think about any debt that you carry, whether that's your mortgage, your auto loans, your credit cards, this is what the financial system runs on. Now, this is the extremely important part. So when someone trades in dollars for the stable coin, then the stable coin is worth $1. Those dollars are taken and invested in US Treasury debt. Now, the yield that is earned on that debt does not go to retail investors like you or I who put our hard-earned money into these so-called stable coins. They go to the issuers. They go to the large USD Tether, USD Circle. If you see those names, those companies are basically pocketing all of that interest while you get the ease of use narrative that the stablecoin purportedly shows you. And the result here is it effectively guarantees that hundreds of billions of dollars in programmatic, legally captive demand for short-term US government debt. Now, this is extremely important because, as we'll go on later in the video, the United States government is almost 40 trillion, yes, with a T, trillion dollars in debt, and it needs to find buyers for that debt. And this is one of the ways in which they're doing it. I want to discuss why, even in the United States, we think about everything in terms of dollars. We've only had to think in one currency. If you live in India, if you live in Turkey, if you live in any Southeast Asian country, you're not only thinking in terms of your local currency, you're thinking in terms of dollars as well. I want you to just imagine, put your imagination cap on and think about you work in Turkey, you own a store, you are working, you earn Turkish lira, but the Strait of Hormuz closes, and then all of a sudden Turkey, they have to buy oil that is priced in dollars. They have to import all that oil to keep the lights on, to keep your business running. So when this occurs, the dollar strengthens against the lira, your purchasing power in your Turkish lira terms goes down. What can you do to circumvent this? Well, you can use a stable coin, which is backed 1-to-1 for $1. So to survive, this owner does not buy cash. Instead, they swap the lira on a digital platform, which is legal in Turkey. And this happens in other foreign countries as well. I'm just using Turkey as this example. They switch it into USD on their phone. So they're circumventing the banking system. So there's less regulations. They can do it in real time. There's not nearly as much cumbersome stuff that they have to get through. And this is preserving their purchasing power against the lira. So global citizens, when they are doing this, they're not doing this because they want to speculate on the price of the dollar versus the lira. They're doing this to survive, because as this inflationary pressure, this inflationary backdrop hits, then they're just having to burn through more and more and more lira to survive. And so this maintains their purchasing power. So like I said, the commodity shock, this is when global oil shot up after the Strait of Hormuz. Then these importing countries, whether you're Japan, whether you're India, Turkey, they need to sell their lira to get dollars to import all of that energy to keep the lights on. So this is the forced liquidation. The lira starts to depreciate, and then it's a vicious cycle. So then you have to buy more oil. The reason I'm harping on this, guys, is because this is what will insulate and create that US dollar demand. Remember, we talked about at the beginning of the video, the government needs to find buyers for its debt, not long-term debt, short-term debt. And so you have all of these foreign players who are losing purchasing power in lira terms or in rupee terms, in yen terms, and they are able to circumvent the banking system and get access to dollars. But again, when you have strong US Treasury yields and commodity prices are forcing people into the dollar, that yield doesn't go to the retail investors like you or me or these international average Joe and Jane investors or business owners. They go to these large multinational corporations. So the $40 trillion bait and switch, okay? So again, the retail deposit, the consumer deposits $1. The last CPI print was 4.2% CPI inflation. Take that with a grain of salt. And then the corporate consortium, we have BlackRock, Visa, MasterCard. They're able to issue these zero yield digital tokens. When they issue these tokens, the issuer captures the real dollar and buys the short-term debt, and the government finds a continuous buyer for its cheap debt, right? So this continuous demand keeps the borrowing costs down. And then whether it's Tether, Circle, they will pocket that interest while you are left holding the bag, while you are left with access to the dollar, but you don't get any yield. So in inflation terms, your purchasing power is being diluted. So the end game here, the US is $40 trillion in debt. A sudden default is impossible. You're not going to raise taxes on a $40 trillion problem. That would be political suicide. You're not going to default, also political suicide. You are going to inflate the problem away. You are going to print so that those liabilities that you hold on your balance sheet, they are going to get diluted and be worth less over time. This keeps borrowing costs down while letting inflation run above target. So the cost, or rather the interest that the government is paying, is less than the true inflation rate, which means they're able to decrease the value of the debt that they owe over time. And this is really bad for individuals who are fixed wage earners like me, or savers, cash under the mattress, or long-term bondholders. All right. But it is really, really good for the individuals that own hard assets, real estate, commercial property, corporate stocks, etc. And that's something that we'll go into. So the structural wealth migration. So we talked about asset poor, cash heavy. You work a 9 to 5, you're working 2 or 3 jobs. You're trying to put food on the table. You're trying to pay your power bill, your healthcare, your childcare. You're not worried about where you're going to put your capital to protect it. As the purchasing power shrinks, wages take months or years to catch up to this inflationary pressures. So in real time, if you think about what's happened over the last 100 days, in real time, gas has shot up to, say from $3 to $5. I know that's an extreme example. Your wages do not go up by 40%, all right? You're always trying to play catch up. And then you're taking out more debt just to pay off the debt. And then you're living on credit cards. Whereas the wealthy class, okay, these are the institutions, the large players that are able to access hard, productive assets, that the value of these assets will expand automatically with the increased money supply. And the money supply is coming from the increased debt that is being printed by the government and being serviced by these stablecoin issuers with your dollars. So in terms of what can we do to protect ourselves? I'll tell you something that I'm doing right now. The absolute guard, I have a self-directed IRA. I have gold and silver. I didn't really care about the price. I put a cap on gold in terms of the price on gold will be capped when we stop printing money. It's that simple. Same as silver. Okay, so I have that in a self-directed IRA. I don't hold cash if I don't have to. Obviously, you need to have purchasing power in the system to buy everyday goods and services and provide for your family. And then the growth plumbing, financial infrastructure. So anything like JP Morgan, anything like Berkshire Hathaway. I also really like natural gas companies with enormous moats. They have incredible infrastructure that pays a really strong dividend that's basically paying you to wait, that can actually sometimes pay you more than what you would earn on a US Treasury yield, okay? So in terms of tactical execution, I really wanted to provide you guys with a cost-effective way to start beating the system. Even if you have $30 a month to put away, put a share into what's called the STU ETF. Why I love this ETF, it's technically a mutual fund, but it has Berkshire Hathaway, 30%, and JP Morgan Chase. JP Morgan Chase is the largest dealer bank in the world, I think, and it also is the largest shareholder of the Federal Reserve, which controls our money supply and controls the cost of money. That's a business I want to own. Not a lot of people have $200-300 to put towards a share each month. This allows you the ability to own these companies at a fraction of the price. So I think it's not here on this chart or on this slide, but it's trading for about 25% discount to its net asset value. So you're already getting it at a discount. The market, in my view, will start to compress that at some point. And like I said, these names, they're not going anywhere. They're staples. Berkshire Hathaway has a complete arsenal in terms of dry powder on the side. $380 billion last I checked, that they are just waiting for the market to turn around and they're going to allocate that capital. So they're the best stewards of capital that you can imagine. And again, you're getting it for a discount. This is just an idea. I buy a share every month for my daughter and I just put it away and I don't even think about it. Okay. All right. So thank you for tuning in to Medicine to Macro. I really appreciate your viewership. I hope you derive value from this. If you have any questions about stable coins, I know it was a very brief overview, but it is important to realize that this is where the era of financialization is going, to digital assets. And they are going to try to get you hook, line, and sinker with saying that it's to keep you secure, to keep you safe. Really, it's an enormous wealth transfer. They're siphoning it, but they're going to be able to get international people, or people from international countries to invest in this because it's all relative. Their currency is falling versus the dollar on average. Okay, guys, with that, I will see you on the next video. Take care.